September 15th, 2008. Lehman Brothers just collapsed. I'm sitting at my desk at GLG Partners, one of the largest hedge funds in Europe, and my phone is ringing off the hook. Every client wants out. Every trader is panicking. Every screen is red. But I'm not panicking. I'm calm, because I saw this coming 18 months. Earlier, I'd already positioned our macro book for exactly this moment. While everyone else was scrambling to sell at any price, I was executing a playbook I'd written a year and a half before. Why am I telling you this? Because that exact setup is happening again. Right now, February 2026, the pieces are in place, the trap is set, and 95% of investors have absolutely no idea what's about to hit them. I'm Raoul. I spent 20 years at Goldman Sachs and GLG Partners. I co-founded Real Vision to democratize financial intelligence. And I've spent the last decade studying what I call the exponential age, the collision of technology, demographics, and debt that's reshaping the entire global financial system. What I'm about to show you is the most dangerous setup I've seen in my entire career. By the end of this video, you'll understand the 3 specific signals that tell you when the liquidity crisis accelerates. You'll see my actual framework for portfolio positioning right now, and I'll walk you through my month-by-month playbook for the rest of 2026. But first, you need to understand something that nobody in mainstream finance is talking about. The liquidity crisis has already started. You just don't see it yet. Let me show you what I mean. Before we go deeper, subscribe and hit the notification bell. This is the kind of macro analysis that institutions pay hundreds of thousands of dollars for. I'm giving it to you for free because I believe financial education should be accessible to everyone. Now, drop a comment. Are you positioned defensively or are you still fully invested? Let's see where everyone stands. The pattern recognition. Let me take you back to a moment that shaped everything I understand about markets. It's 2006. I'm running the hedge fund sales business for GLG in Europe, and I'm watching something that doesn't make sense. Credit spreads are at historic lows. Everyone is lending money to everyone. Subprime mortgages are being packaged into securities and sold to pension funds as safe investments. And the mathematical models that Wall Street was using, they all said this was fine. They said housing prices never go down nationally. They said the risk was diversified. They said it was a new paradigm. You know what I did when I heard new paradigm? I started building my short book, because I've studied financial history obsessively, and every single time someone tells you this time is different, it ends the same way: total collapse. The fundamentals always matter, always. The math always wins, eventually. So I positioned early, way too early, actually. I was about 18 months early, which in hedge fund terms is painful. But when the crisis finally hit, when Lehman collapsed, when the entire global financial system froze, I was ready. Here's what keeps me up at night right now. The setup today is worse than 2007, worse than 2000, worse than any period I've analyzed in my 35-year career. And I'm going to prove it to you with simple math. The debt doom loop. Let me show you the arithmetic that nobody wants to talk about. The Federal Reserve's balance sheet in 2008, right before the financial crisis, was $870 billion. That's what they had to work with to save the system. Total US government debt at that time was $10 trillion. Fast forward to today, the Fed's balance sheet is $7 trillion. Sounds like a lot, right? But US government debt is now $38 trillion. Let me say that again. $38 trillion. Here's where it gets truly insane. The interest payment on that debt, just the interest, not paying down the principal, just the interest, is now $1.1 trillion per year. The United States government spends more money on interest payments than it spends on national defense, more than the entire military budget, just paying interest on money we already borrowed. Do you understand what this means? Every single dollar the government spends on interest is a dollar that doesn't go into the productive economy. It's just servicing past decisions. It's a tax on the future. And here's the kicker. That $1.1 trillion is calculated at an average interest rate of around 3.25% across all US debt, but new debt is being issued at 5% or higher. As old bonds mature and get refinanced at higher rates, that interest payment is going to explode. $1.5 trillion, $2 trillion, $2.5 trillion. It becomes what I call a debt doom loop. You borrow to pay interest, which increases your debt, which increases your interest, which forces you to borrow more. This is not political. This is not partisan. This is simple arithmetic. And the arithmetic says the current path is unsustainable. The liquidity trap explained now. Might be thinking, okay, Raoul, the debt is high, but the economy seems fine. The stock market is near all-time highs. Unemployment is low. Why should I be worried? Let me explain the mechanism that's about to break everything. This is what I call the liquidity trap, and understanding it is the key to navigating what's coming. The US government is selling $2 trillion of new debt this year. Someone has to buy it. Who's buying? Not China. Their holdings of US treasuries have dropped from over $1 trillion to under $800 billion. They're actively reducing exposure. Not Japan. They're selling us treasuries to defend their own currency. Not OPEC nations. They're diversifying into other assets. So who's buying all this debt? The answer is us banks, US pension funds, and us money market funds. In other words, the government is borrowing from its own citizens. We're funding our own deficit by pulling money out of the private economy. Every dollar that goes into treasury bonds is a dollar that's not going into stocks, corporate bonds, real estate, or small business loans. The government is sucking liquidity out of the entire financial system to fund its deficit, and at the exact same time, the Federal Reserve is running quantitative tightening. They're shrinking their balance sheet by $60 billion per month. That's $720 billion per year being removed from the system. Let's add it up. $2 trillion from Treasury borrowing, $720 billion from Fed 2, that's $2.7 trillion of liquidity being drained from the financial system in 2026. Let me put that in perspective. The entire market capitalization of Apple, the largest company in the world, is about $3 trillion. We are removing almost one Apple worth of liquidity from the system this year, and people are wondering why I'm cautious. The 3 stages of a liquidity crisis. Here's what nobody is telling you. This liquidity drain doesn't happen all at once. It happens in stages. It's like watching a dam develop cracks. First small leaks, then larger ones, then catastrophic failure. Let me walk you through the 3 stages so you know exactly what to watch for. Stage 1. The illusion. 2023 to 2024, the Fed raised interest rates to 5.5%. Everyone panicked. This will crash the market, they said. But the market kept going up. The S&P hit new all-time highs. Bitcoin rallied. Everyone was confused. Here's what they missed. While the Fed was raising rates, the Treasury Department was draining the Treasury General Account. That's the government's checking account at the Fed. They drained over $600 billion from that account and injected it directly into the financial system. So you had this bizarre situation where rates were high but liquidity was abundant. The market looked at the liquidity, not the rates, and went up. This is why I always say, don't fight the Fed, but more importantly, don't fight the Treasury. Liquidity is the master. Everything else is noise. Stage 2. The squeeze. Right now, February 2026, the Treasury General Account is depleted. There's nothing left to drain. Now the government has to actually borrow money to fund its deficit, and that's when the real liquidity drain begins. Here's where it gets dangerous. Most investors don't understand what's happening. They see stocks near all-time highs and think everything is fine, but underneath the surface, liquidity is evaporating. Trading volumes are declining. Bid-ask spreads are widening. Small-cap stocks are already in a bear market. The Russell 2000 is down significantly while the headline indices mask the damage. Nobody's noticing because the mega-cap tech stocks are holding up the averages. This is exactly what happened in 2007. The cracks started appearing in subprime mortgages in early 2007, but the S&P 500 didn't peak until October. For 9 months, the foundation was crumbling while the roof looked fine. Then the whole house collapsed. We're in that 9-month window right now. Stage 3. The break. Late summer to fall 2026. This is what I'm watching for. First, small cracks appear. A regional bank fails, a private credit fund gates redemptions, a corporate bond offering gets pulled because there are no buyers. The financial media calls them isolated incidents. Then the cracks spread. Credit spreads widen. High-yield bonds sell off hard. Margin calls trigger forced selling. What was orderly becomes disorderly. Suddenly everyone wants out at the same time, but there are no buyers. Liquidity disappears completely. Finally, the panic. The Fed realizes they broke something. They reverse course. They restart quantitative easing. They cut rates. But here's the problem. This time, nobody believes them, because they've cried wolf too many times, because inflation is still elevated, because their credibility is damaged. That's when you get a real crash. 30%, 40%, maybe more. And it happens fast, not over months, over weeks. If you're finding this framework valuable, hit that like button. This is the institutional grade analysis that most retail investors never get access to. The 3 signals I'm watching now. I know what you're thinking. Raoul, you've been cautious before. You've been early before. What if you're wrong again? Fair question. Let me address it directly. Yes, I've been early. In macro investing, being early and being wrong feel exactly the same until they don't. But here's my philosophy. Being early is not the same as being wrong. Being early means you preserve capital and you're ready when the turn comes. Being wrong means you blow up and you're not around to play the next hand. So yes, maybe I'm early again, maybe this doesn't fully play out until 2027, but I'd much rather be 6 months early and safe than 1 day late and bankrupt. Let me give you the 3 specific signals that tell you when everything accelerates. Signal 1. The 10-year Treasury yield crosses 5% and holds right now. The 10-year yield is around 4.3%. If it breaks above 5% and stays there for 3 consecutive days, that's your first major warning. Why does this matter? Because 5% means the bond market no longer trusts the trajectory of US government debt. It means investors are demanding a higher risk premium to lend money to the Treasury. When that happens, the government's interest costs explode immediately. They're forced to borrow more just to pay interest on existing debt. The doom loop accelerates, and the Fed loses control because they can't cut rates without risking a dollar collapse and inflation resurgence. When you see 5%, pay attention immediately. Signal 2. The regional bank index drops 30% from current levels. The CRE ETF tracks regional banks. It currently trades around $45. If it falls to $31.5 or below, a 30% decline that signals a systemic banking crisis is unfolding. Why regional banks? Because they hold most of America's commercial real estate loans, and commercial real estate has declined 40% in value in many markets, but it hasn't been fully marked to market yet. The losses are hidden on balance sheets. They're using accounting tricks to avoid recognizing reality. When deposits start fleeing and banks are forced to sell assets to meet withdrawals, those hidden losses become real. Then you get bank runs, FDIC interventions, a cascade of failures. Silicon Valley Bank was the appetizer. The main course hasn't been served yet. Signal 3. Credit spreads explode to 6% or higher. Watch the spread between high-yield bonds and investment-grade bonds. Right now, the spread is about 3.5%. That's calm. That's complacent. But when it hits 6%, that means the credit market is freezing. Companies can't refinance. Defaults spike. The transmission mechanism of the economy seizes up. This is what happened right before Bear Stearns and Lehman collapsed. Credit spreads blew out first, then everything followed. When credit spreads hit 6%, the crisis is no longer theoretical. It's here. My framework for positioning. So how am I thinking about portfolio construction right now? Let me be very clear. I'm not giving you financial advice. I don't know your situation, your risk tolerance, your time horizon. What I'm sharing is my framework, how I think about this environment. Bucket 1. Cash and short-term treasuries, 30-35. Yes, more than a third in cash equivalents, earning about 5% risk-free. People tell me this is stupid. Cash is trash, they say. You're losing to inflation. You're missing the rally. Here's what they don't understand. Cash is optionality. Cash is the ability to act when others are forced to react. When everyone else is selling in a panic, when liquidity has evaporated, when assets are trading at 50 cents on the dollar, that's when cash becomes the most valuable asset in the world. In 2008, the people with cash were able to buy generational assets at generational prices. Everyone else was just trying to survive. Cash isn't a return. It's a call option on future opportunity. Bucket 2. Hard assets, gold, Bitcoin, and commodities, 25-30. This is where I differ from traditional macro investors. I own gold. Physical gold, gold miners, gold ETFs, because gold has been money for 5,000 years. When trust in government breaks down, when currencies debase, gold is the asset that doesn't require anyone's promise. But I also own Bitcoin, and this is important. Bitcoin is not just digital gold. Bitcoin is a network. It's the hardest money ever created, mathematically provable scarcity in a world of infinite money printing. When the Fed eventually pivots, and they will pivot, they always do, they will print aggressively, and that printing will flow into hard assets. Gold will do well, Bitcoin will do better, because Bitcoin is smaller, more volatile, and more sensitive to liquidity flows. I also have energy exposure, oil, natural gas, uranium, because you can't print oil. The Fed can create infinite dollars, but they can't create a single barrel of crude. Bucket 3. Selective equity exposure, 20-25. I'm not fully out of stocks, but I'm selective. I own cash-flowing businesses with pricing power, companies that can raise prices in an inflationary environment, consumer staples, healthcare, defense contractors. I own some technology, but only the platforms that are essential infrastructure, the picks and shovels of the digital economy. I avoid anything that requires cheap money. To survive, unprofitable growth stocks, SPACs, meme stocks, anything trading at 50x revenue with no path to profitability. Bucket 4. Hedges and optionality, 10-15. This is insurance. Put options on the major indices, volatility exposure, positions that pay off when everything else is falling. Most of the time these positions lose money. They're designed to lose money slowly, but when the crisis hits, they explode in value. In 2008, my hedge book made back everything I lost on the way down, and then some. Insurance is not about making money, it's about surviving to play another day. The month-by-month playbook. Let me walk you through how I'm thinking about the rest of 2026. Phase 1. Now through summer, stay defensive. Current positioning: 35% cash, 25% hard assets, 25% selective equities, 15% hedges. I'm watching all three signals like a hawk, and I'm waiting for the catalyst. It could be a bank failure, it could be a sovereign debt crisis in Europe or Japan, it could be a corporate default that triggers contagion. I don't know where it will start, but I know it's coming. During this phase, I don't chase, I don't get FOMO. I sit on my cash, earn my 5%, and wait. Patience is the hardest part of macro investing, but it's also the most important. Phase 2. Summer through fall. When signals trigger, when I see 2 of my 3 signals activate, I increase defensive positioning significantly. New allocation: 40% cash, 30% hard assets, overweight Bitcoin and gold, 15% defensive equities, 15% hedges. This is when preservation becomes everything. I'm not trying to make money, I'm trying to not lose money, because every dollar you don't lose in the crash is a dollar you can deploy at the bottom. Phase 3. Late fall through winter. The opportunity. This is the hardest part, recognizing when the selling is exhausted. How do I know when? I watch for Fed action, not their words mean nothing. Their actions, when they actually restart QE, not hint at it, not suggest they might consider it, but actually start buying assets. That's your signal. The bottom is forming. At that point, I start deploying cash into quality assets at distressed prices. Bitcoin at 50% off, Microsoft at 40% off, the best companies in the world on sale. Phase 4. 2027. The recovery. The crisis passes. The Fed has printed. Liquidity returns. Assets recover. I move from defense to offense. New allocation: 15% cash, 35% hard assets, Bitcoin, gold, 40% equities, 10% alternatives. This is when you build wealth for the next decade, but you can only do this if you survive the crisis with capital intact. Why this time is different, and I don't say that lightly. Let me tell you why this crisis could be worse than 2008. Every previous crisis had an escape hatch, a way for the Fed to ride to the rescue. 1987 Fed cut rates and flooded liquidity. Crisis over. 2000 Fed cut rates from 6% to 1%, crisis over. 2008 Fed cut to zero and printed $4 trillion, crisis over. 2020 Fed printed $5 trillion in 6 months, crisis over. But this time is different, and I hate saying that because this time is different are the 4 most dangerous words in finance. But this time actually is different. The Fed can't cut rates to zero because inflation is still elevated at 3%. If they cut to zero, inflation spikes back to 8% or higher. They can't print unlimited money for the same reason. Every dollar they print fuels inflation. They're trapped. If they keep rates high, they break the economy and the banking system. If they cut rates and print, they get runaway inflation and a collapsing dollar. There is no good option, only bad and worse. This is why I believe we're entering the most challenging period for central banks since the 1970s. The playbook that worked for 40 years doesn't work anymore. The mistake that will destroy you. I need to warn you about the one mistake that will absolutely destroy your portfolio, and I see people making this mistake every single day. The mistake is refusing to change your mind when the evidence changes. I've watched billionaires go bankrupt because they couldn't admit they were wrong. I've seen brilliant investors lose everything because they were too stubborn to adapt. In 1998, I was convinced the Asian financial crisis would spread globally. I positioned aggressively, and I was early, too early. It cost me. You know what I did? I reduced my positions. I admitted I was early. I preserved capital. And when the opportunity came later, I was ready. The lesson: don't marry your positions. Don't marry your narratives. Markets can stay irrational longer than you can stay solvent. When the facts change your strategy. Right now, the facts say liquidity is draining, rates are staying high, and valuations are stretched, so I'm defensive. But if the Fed pivots tomorrow, if they announce emergency QE, if they change the game, I'll adapt immediately. I don't care about being right. I care about making money and preserving capital. Check your ego at the door. Your ego will bankrupt you faster than any market crash. Final thoughts. Look, I know this video is sobering. I know it's not what you want to hear when your portfolio is up and everyone around you is making money. But I didn't build my career by telling people what they want to hear. I built it by telling them what they need to hear. The liquidity crisis has already started. The math is broken. The trap is set. The only question left is timing. You have a choice right now. You can ignore everything I've just shared and hope I'm wrong, or you can take defensive action and position yourself to not just survive, but to profit from what's coming. I'm not saying sell everything and hide in a bunker. I'm saying be smart, build cash, own hard assets, hedge your longs, get out of garbage, don't use leverage. When this hits, 95% of investors will see significant drawdowns, but the 5% who positioned correctly won't just survive, they'll be able to buy assets at generational prices. In 2008, the investors who were positioned correctly didn't just survive, they bought the greatest companies in the world at 50% discounts. They built wealth that lasted decades. You have that same opportunity right now. The setup is complete, the signals are clear, the timeline is 9 months or less. Which 5% will you be in? If you found value in this framework, subscribe to this channel. I don't do hype. I don't do hopium. I do macro analysis based on 35 years of pattern recognition and institutional experience. Leave a comment and tell me which of the 3 signals you're watching most closely: the 10-year yield, regional banks, credit spreads. And if you know someone who needs to understand what's coming, share this video before it's too late. The liquidity trap is here. Most people don't see it yet, but now you do. Position accordingly. This is the exponential age, and in the exponential age, the winners are those who see the pattern before everyone else. I'll see you in the next one.